24 seconds away from the opening bell this morning. Good morning to you all. We pull back on the S&P. Off-session lows just on the Nasdaq. We're down by 0.8%. On the S&P 500, down by 0.6. 5 is not the magic number. We're heading towards a fifth week of losses on the S&P. Unless that changes. There's your opening bell. Switch to the board and get to the bond market. Heading towards a fifth week of yields climbing on a 10-year maturity. Your 10-year this morning higher by 12 basis points to 484. Yields up, dollar stronger, euro lower, 105.12. The euro poised for a 12th consecutive week of euro weakness against dollar strength. The dollar absolutely dominant in G10. That currency pair pulls back by a third of 1%. And crude, look out below, all week heading towards the biggest weekly loss potentially going all the way back to March. Crude right now positive by 0.6%, 82.83. About 30 seconds into the session, this looks better than it did about an hour ago. On the S&P, we're down about a half of 1%. On the Nasdaq, down by about 0.7. One stock to watch at the open is Exxon, the energy giant in talks to acquire Pioneer Natural Resources, nearing its largest takeover since 1999. Citi saying the following: the logic of consolidation in the highly fragmented Permian shale remains compelling, with significant gains to be achieved. Abby has more. Hey, Abby.
Hey, John, and yes, this is a big one. So sources are saying that ExxonMobil is very close in advanced talks to acquire Pioneer Natural Resources. It could value Pioneer at $60 billion. Yesterday, Pioneer had been worth $50 billion. They, of course, are one of the premier producers from the Permian Basin, which is basically in runs from parts of Texas and New Mexico. It's one of the most lucrative parts of the oil patch in the U.S. because it's much more easy to extract the oil. So what this would give Exxon essentially is, rather than buying a company where they would potentially have to develop unproven acreage, almost like a faucet where they can turn it on and off. So when oil is lower and volatile and it's been weighing a little bit, ExxonMobil into today had been down about 1%, and Pioneer into today down about 5% on the oil volatility, plus concerns that there could be a global slowdown and that would weigh on oil. But if there was a resurgence, they basically just have to bring out this oil. It's not quite as simple as that, but that's one way to look at it. Now, sources are saying that this deal could close in coming days, but it might not be super easy, John, because there could be some solid political and regulatory issues, scrutiny, given the fact that earlier this year in February, the White House did accuse Exxon of achieving what are called bumper profits at the expense of consumers. Stay tuned, but right now we do have Pioneer up about 8%, Exxon down 3%, suggesting that many do think that the deal could actually go through.
Stay tuned. Abby, thanks for that. Let's turn to the autos. GM presenting its sixth contract offer to the UAW, writing in an email that they're ready and willing to negotiate in good faith 24/7 to reach an agreement. This coming as Union President Shawn Fain prepares to deliver an update on social media at 2 p.m. this afternoon. Simone Foxman on top of this story. Hey, Simone.
Hey, John. Yeah, all eyes are on that announcement, which will be Facebook Live, YouTube, etc. in this day 22 of the United Auto Workers strike. We could hear plans to expand the strike today. Right now, 25,000 United Auto Workers are striking of the 145,000 total population, and so far the strikes haven't impacted the plants that produce the full-size pickup trucks, the large SUVs that are the most profitable for these companies. So we're very much focused on where we see those potential strikes expand, because they could have more of a hit than we've currently seen on their bottom line. And we'll also be looking for whether or not the union is going to reward progress on some of the talks, including perhaps with GM, where it does seem both sides have made some progress a little bit on retirement benefits, even though GM very much focusing on strengthening 401ks. However, despite that announcement from GM that there was this offer submitted, we saw shares close at their lowest since September 2020. Ford has also been under pressure, really lowest since August. Stellantis is holding up better a little bit because of its global operations, and shares of all those companies are down, or Stellantis unchanged today.
Simone, thank you. More on this story with the Acting Labour Secretary, Julie Su. We'll cover this in about 10 minutes' time. Let's check out shares of Tesla right now. Tesla cutting prices on its top-selling models in the US again after Q3 deliveries fell short of estimates. CEO Elon Musk taking to X to challenge his critics, writing this: "Sometimes they question if I should even run Tesla. My response is simply, watch other CEO. Would you prefer?" Isabel Lee has more. Hey, Isabel.
Hey, John, lots of markdowns across the board. The company slashing the starting price of its base Model 3 by $1,250. It's slashing the long-range version of the sedan by the same amount. And the Tesla also shaved some $2,000 off the price of the performance version of the Model 3 as well as the performance versions of the Model Y sports utility vehicle. So what do these discounts mean? Two things. It will dampen the company's profit margins, but it will help stoke demand. And we have the CEO, Elon Musk, downplaying the trend so far. He said that, the company could sacrifice earnings up front, but it could make it up by software upgrades. Tesla shares are now dropping by some 2.5%. The stock has more than doubled this year, John. It's up by 111%. Tesla has delivered some 435 vehicles in the last 3 months, but it's still short some 20,000 of what analysts were expecting, John.
What a move on that name this year. Isabel, thank you. 254 in early trading. Let's finish on consumers. Levi's wholesale concerns persist after reporting third quarter results. The CFO saying this: "Given the ongoing uncertainty in the macro environment, we're taking a cautious approach to our outlook for the fourth quarter." Katie, that stock down 3%.
Yeah, it is a down day for denim. Quarterly revenue came in light, and that led the company to take a, quote, more cautious approach to its projections. Levi now sees EPS at the lower end of its previously stated range while scaling back its revenue outlook as well. Now, if you take a look at the last few quarters, Levi actually either met or beat its estimates, which makes, of course, this latest round of earnings even bleaker. And of course, they're the first major U.S. apparel retailer to report, and their results are closely watched for that reason. Levi CEO told Bloomberg News in an interview that, quote, "middle-income consumers and below are definitely being impacted, especially here in Europe, but that's also true in parts of Europe as well." Now, the sell side not too impressed. While the direct-to-consumer business was a bright spot, it was the wholesale business that remains a concern in some of the reports coming out this morning. And you can see that in the shares. Levi currently down about 2.7%.
Katie, thank you for the update. Allow me to give you the update for the broader market. If you're just joining us, where have you been? You missed it all in the last hour. The jobs report, a blowout number, 336,000. The estimate, 170K. The previous number, 187. The move you might expect. About 16 or 17 minutes in, or rather 6 or 7 minutes in, equities are down by about 0.5% on the S&P. The Nasdaq's down about 0.5%. Major moves in this bond market. Yields up another 12 basis points to about 484 on a 10-year. On a 2-year, back to 5.1%. On a 30-year, we're back at 5%. We're back now with PGIM's Mike Collins, Crossmark's Victoria Fernandez, Mohammed Al-Arian. Mohammed, I want to come straight to you and ask you about the financials, the banks. Typically, we talk about good data, higher yields, good for financials. That's not happening. Why not?
I think the markets are concerned about two things. One is the impact of higher NIMs, potentially. Higher net interest margins are being offset by deposit outflows out of banks into money market funds. The second issue, which is of more concern to the market, is that there's a worry that if interest rate risk continues to be in play like this, it will translate into credit risk and liquidity risk. And I think that is what's being captured by yet more pressure on the financials.
Victoria, is that something you're worried about?
Yeah, I mean, I mentioned a few minutes ago that we were concerned about the liquidity issues that we're seeing in the market, and I think that's part of what you are seeing in the financials, along with the fact that you're seeing like Citi say that charges on credit cards was actually down over the last few weeks. So the consumer is getting hit a little bit harder. That has to be concerns growing then around lending, around delinquencies on credit cards. All of that feeds in to what these financials are doing. And when you tighten those financial conditions and when you squeeze the liquidity that's in the market, financials are not going to do well, even with the re-steepening of the curve. I do think, however, we'll see financials start to come back because their balance sheets are strong. So even with all the macro data that's going on, the balance sheets themselves should be able to hold through the volatility. So I think you want some exposure to them for longer-term holdings in your portfolio.
Mike Collins, I want to talk about these unrealized losses in this Treasury market. The price destruction in treasuries, particularly at the long end, since we peaked back in spring 2020, has been absolutely phenomenal. The team here at Bloomberg broke down the numbers earlier in the week, and at the time that story was published, the numbers looked like this. Bonds maturing in 10 years or more, they've dropped 46% since peaking in March 2020. 30-year bonds, even worse, tumbling 53%. These are monster moves, Mike. They're getting even worse this morning. Mike Collins, who owns that? Where's that pain right now? Where's it sitting?
Yeah, Jonathan, that's exactly where I wanted to go, and that's kind of the third leg of Mohammed's stool that could hit not only financials, but broadly the whole economy, right? And who owns those bonds? Fortunately, you know, the Treasury or the Fed owns about 8 trillion of them, right? So that actually does cushion the blow to the private sector. But insurance companies own them, pension plans own them, individuals own them, and it's not just bonds being marked down, Jonathan, it's all asset prices. I just came from a real estate conference, and people are really worried about the potential for a lot of forced selling. A lot of people bought real estate at high prices over the last couple of years, and those marks are moving down, and they still have a long way to go down from where they are today. And the financing cost, if you didn't lock in your rate, is going in the opposite direction. So a lot of these are now underwater, right? So it's really across the whole economy. You see it in stock prices every day, but it's really the slow-moving prices. It's the private debt. It's the commercial real estate. That's another shoe that hasn't dropped yet.
So, Mike, I want to push you a little bit more on this, if I may. Because it's not just domestic, it's global. People are also worried about the spillback from the Japanese reaction. So is this a slow-moving process that the market can accommodate and the economy can accommodate? Or is this something we should be worrying about tipping points?
You know, I think it is a slow-moving process. Our base case, Mohammed, is that there isn't as much leverage in the system generally. Like a lot of this real estate hasn't been overbuilt. It hasn't been levered. Certainly the housing market is not levered at all. The banking system, as Victoria pointed out, is not a levered system anymore, right? So that's really good. But as the realization of these lower asset prices, and you do get liquidity events and flows where people have to realize those losses at some point. And so maybe it takes quarters or even years to get realized, not days and weeks, but that is something that does nag at us over the intermediate term and make us certainly more cautious on the global credit markets in general.
Mike, we've heard a lot of Wall Street phrases, cliches through the week, catching falling knives, buyer strikes, all of that bad stuff. Mike, your colleague, Dalip Singh, talked about the loss of predictable demand in the Treasury market, China, the Federal Reserve. Mike, that's not coming back potentially. How does that change things? That change of character in the sources of demand, what does that mean for this Treasury market, this Treasury curve?
Yeah, I mean, part of that, believe it or not, Jonathan, again, this is kind of wonky stuff. Some of that is priced in. If you look at long-term Treasury yields versus long-term expectations of the funds rate or other derivatives on that interest rate, it's about a 70 basis point yield premium that the Treasury is actually paying every time they go to the auction block to issue Treasury. So there is a supply premium already built in. You could call it a credit premium in some cases on the Treasury market, built in already, and that's one of the reasons that yields are at these higher levels, and whether that persists or not is anybody's guess, but it's a little encouraging that a lot of that is priced in.
Mike Collins, thank you. Mike Collins alongside Victoria Fernandez, together with Mohammed Al-Erin. I'm pleased to say Mohammed's going to stick with us. Stocks pulling back by about 0.6% on the S&P 500. Up next, the September payrolls report coming in hot.
This is a much stronger labor market. Clearly, that's what we see in the report today across the board.
Acting Labor Secretary Julie Su up next. Live from New York City on Bloomberg TV and on Bloomberg Radio, I'm Jonathan Ferro. Joining us now from Washington is Julie Su, the acting U.S. Secretary of Labor. Julie Su, wonderful to catch up with you. A hot labor market report at a time where the unions seem to have a lot of leverage, so let's go straight there. What's your latest read on the UAW negotiations?
Well, the parties are at the table. They're continuing to negotiate. The president has made very clear, something I believe in too, that when there are record corporate profits, there should be record contracts for working people, and that's what workers are fighting for. So the negotiations continue, and I believe that the parties will get there.
Are you getting access to both parties to help negotiate a settlement?
Yeah, we're talking to both parties. I mean, again, the collective bargaining process is about the parties themselves coming together, working through their issues, finding common ground and win-win solutions. We support that in every way that we can, and we are continuing to talk to the parties in that particular situation.
What have you heard recently about current demands from UAW? We understand that wage demands have come down from 40 closer to 30. Is that your read on things?
I mean, and the negotiation is always about movement on both sides. At this point, I think it's always hard to know exactly where something will land. I think as long as they're talking to each other, that is positive, and that is what is happening.
You're sensing the gap is closing. The spread has narrowed.
I'll say it this way, I've seen this a lot. I think that the parties always seem like they're far apart until they're not. So that always requires movement. And I think the continued engagement is a positive thing, and it's part of the reflection of President Biden and this administration's commitment to workers getting their fair share in an economy that is doing really well.
We also have healthcare strikes as well. I understand you've met leadership from both sides. Julie, how different is that particular strike? What do you think is going on there?
I mean, every strike has its unique issues, right? The industries are different, the specific demands are different, but I think the bottom line is that we are seeing a resurgence in worker power, in support for unions in the economy, and for working people demanding their fair share, saying, enough of the disparities between what frontline workers make and what CEOs make, making sure that there is an opportunity for workers to improve their working conditions and live stable lives. This is not just an accident in a Biden-Harris administration. It is very much a deliberate part of how we think a strong economy and a strong country works.
Madam Secretary, as you rightly said, we are seeing a shift back in bargaining power towards labor after decades where it went the other way. That's being reflected in a spike higher in number of days of strikes throughout the economy. Should we expect that number to go even higher?
I think it also reflects really record contract results, right? So we've seen from the ports on the West Coast to the Teamsters and UPS, really results that demonstrate workers getting more in wages, ending forced overtime, dealing with other specific issues within certain industries, or automation and the like, addressing conditions like heat and other kinds of health and safety issues. So I think those are the big results. And some of them we're talking about, we don't talk about them as much, but there are, graduate workers who have gone on strike for brief periods and gotten contracts that they want. So I don't know what the average number of days is, but I do know that workers coming to the table, being able to have the right to demand their fair share is something that has been positive for workers and is very much part of the strong economy that we've been talking about, and the jobs report reflects this.
And yet we have not seen that in the numbers on earnings. So is it just a lag effect? Are we going to see it going forward? Or is there something else going on in the economy that's offsetting those gains that you talked about for workers?
Yeah, so earnings are up a bit. We definitely especially see that among lower wage workers, which is part of this idea that, the president has said, we're going to build an economy that leaves no one behind. That starts by looking at who's been left behind in the past. And to the extent that those lower wage workers are seeing average gains that are growing and also that are higher than inflation, means that workers have more money in their pockets, more to spend in their local economies, companies. That's also partly fueling the other effects of the jobs report, which is, more job growth in leisure and hospitality, for example. All of these taken together, along with the historically low unemployment rate, still under 4% for over a year and a half, the longest stretch of the 1960s, are all signs that this economy is a place that, is doing well because of good economic policies and workers having a seat at the table.
Well, let's talk about those policies. There is something really peculiar going on at the moment. If you think about what's happening at the picket line, they have serious concerns about the EV transition and their participation in it. A transition that you are subsidizing. Something really odd from my perspective, and I'd love some clarity from you on it. Why is the government offering rich people credits to buy expensive cars?
So a couple of things. There is widespread support in the country for tax credits that will help to bring manufacturing jobs to the United States. That's part of what we're trying to do. The other is that we do have a climate crisis, right? We saw record heat across the entire country.
Oh, without a doubt. Can I just jump in? Without a doubt. I totally agree with you, but I just think we're conflating solving a climate crisis with driving really heavy SUVs that run on electricity. Are those two things part of the same story? Because I don't get it. If I'm driving an electrified F-150, am I really saving the planet?
Right. Well, so we could probably have a conversation now about personal choices relating to cars. I do think as a policy matter, the more that we can invest in industries, in manufacturing, including in transportation, that transitions us to a place where we're not continue to pollute the planet, right? We have a method by which we can both bring down emissions and also create good jobs. And the president has always said that solving our climate crisis, when he looks at that, it's also about creating good jobs and good union jobs in communities that need them the most. And we are really focused on making sure that that transition does not leave workers behind, and that what's good for the climate can be good for workers as well.
Julie, appreciate the update. Julie Su, Acting U.S. Secretary of Labor. Equities down, your trading diary up next.
Great questions.
Mohammed Al-Arian, you get a final word this morning. What a morning so far.
It is a morning, John, and it's one that should remind us, whether it's the job reports, the UAW, that it is about the supply side. We should get used to the fact that the supply side is a constraint, and that means difficult decisions across the board. And unless we make these difficult decisions quickly, including at the Fed, we may mishandle this last mile in the fight against inflation.
Mohammed, thank you, sir. Fantastic to catch up this morning. Live from New York, this is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, October 6th. We made it. Here are the top market stories we're following for you at this hour. Landing? What landing? September jobs number blows the lights out, pushes back Fed cuts, raises the odds of another increase this year. We're going to talk to Sophia Drosos, .72 economist and strategist. And bond bears in control. You got yields jumping 10 basis points plus pretty much all across the curve. Stock sinks and the dollar rallies. And a big deal for big oil. Exxon nears a takeover for shale giant, Pioneer Natural Resources, potentially for $60 billion in a blockbuster tie-up. This would be Exxon's biggest acquisition since 1999. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. So this is a way to end the week, Guy.
Yeah, we always talk about the fact that the payroll number is an important number. I think it just kind of proved just how important it can be. I am, though, struggling to figure out what you think is the most important story of the day.
Please.
Is it the payroll number or is it the Pioneer number?
Hello, it's Exxon and Pioneer for me. I've been in this tunnel since last night. This would be a humongous deal and have big implications for the industry and for D.C. and policy, but, we'll get to that.
Yep. Could be peak Permian. You pointed that out to me a little bit earlier on.
I did.
Maybe that's the question we should be asking. Are we at peak rates? Well, maybe today's number, Alex, pushes back on that idea. You're seeing a big rally, of course, obviously, in yields today. Bond prices pushing lower. Equities down pretty sharply. That was an incredible number. And it was the revisions, and it was the breadth, and it was everything about this that just convinces us that this is a solid number. I wonder what this market would look like if we got a solid CPI print next week as well.
Yeah, or are we starting to price that? I don't know. Although the wage number it came back a little bit. Ben Emmons was the only one who kind of nailed this number. He was like, if you add up ISM manufacturing, ADP, and you have claims, if you put all the numbers together and you just do a regression analysis, you got this number. So maybe all that data actually makes sense and works.
Yeah, though people are pushing back a little bit, maybe more firmly today on that ADP print and questioning what value it has. Anyway, our question of the day, you laid it out pretty well at the top. What landing? This is an economy that still feels like it's going from strength to strength to strength. Obviously, yields, though, continue to climb. And over here in Europe, we don't have the benefits of that strong labour market. So let's talk about where we go from here. Are we seeing a landing in the U.S. economy? Mike McKee joins us, of course. Denitsa Tevkova joins us in New York as well. She's there now, which is fantastic. All in one place. Denitsa, let me start with you. What landing?
I think we still have a really good chance of soft landing. Obviously, today data is changing a lot of things for the Fed. We've been talking about higher for longer. And if we look at the print today, this is obviously something that we hear a lot stronger. We can see what's priced into the swaps today. We were expecting a reg cut in July, and now it's priced in September. So a really big difference. But also, the other side of this is financial conditions, and they've been tightening at a very fast pace. And we know numerous Fed officials have actually been talking that this has been doing the Fed job. Stocks and bonds have been selling off, and financial conditions per the Goldman Sachs index are actually the tightest in a year. So, of course, that adds another piece to the pie, and even though today the reaction is very negative, some of it's coming down, long term there are some catalysts that still can help that soft landing.
Yeah, I mean, you heard Mary Daly talk about that yesterday in terms of the move in yields. Okay, Mike, now if it was my question to be like, dude, where's my landing? So,
I like
dude,
the way
where's
you
my
put that.
landing?
That's why we don't let her set the question.
Well, after the show, when we can speak and not get the FCC involved, I'll tell you what my question would have been.
Guy had one very similar to yours. Yes.
But landing, I don't know. I'm struggling to come up with a good metaphor for what we saw today, because job creation was so strong, particularly in the service industries, and yet we saw average hourly earnings start to slow down or continue to slow down, especially for service industries, up only 1.7%. So no real wage pressure coming from this enormous jobs number. So that's good news for the Fed. And I suspect that that what will really be important is the CPI now. If CPI comes in as forecast, which is at about half the level it was on a month-over-month basis the prior month, then we will see the Fed maybe stay on hold because they don't have to fight inflation and they can still have this strong economy. And you know that Mary Daly yesterday told Bloomberg that essentially the markets have already priced in a move for the Fed. So I'm not as sure as some people are that this is going to lead to a market reaction, or to a Fed reaction rather, and force them to raise rates.
Okay, let's talk about, let's put the rate rise to one side. Let's talk about the higher for longer bit though. This is an economy that doesn't in any way, shape or form feel like it needs rate cuts right now. Isn't that where the debate really should be here? Yes, maybe we get 25 in November, maybe we don't. But it's really about, this is an economy that's not slowing down sufficiently, back to the no landing kind of idea, to justify any kind of a rate cut.
Well, on a historic basis, you'd be absolutely right. The problem is this is not the economy. It's not the monetary policy that we have seen in the past. The models don't work, and it's hard to figure it all out. If you were just looking at the economic data at this point, you would be saying the Fed may have to do something because the economy is running very hot. But with inflation coming down, that story doesn't completely hang together. And then you throw in the idea of real rates as inflation falls getting even tighter, and so therefore the Fed maybe does want to bring rates down because they want to keep the same amount of pressure on the economy, but they don't want it to get any tighter than it is. So it's going to be really hard to figure this out, and I'm glad I don't trade Fed funds futures.
Yeah, no, I don't, neither am I. Denise, talk about then, put those two together, because Guy was talking about if we get a hot CPI print next week, and we have a 10-year that feels really reluctant to get to 5%, but like it kind of wants to, but then the market seems to back off. Do we get there next week if we get a hot CPI?
Yeah, I think it's obviously like markets have been very sensitive towards very positive data, and any type of good economic news have been very bad for markets. And we have seen some of those reactions have been very sharp. So how far can we go? That's kind of a question that's been here for a while, and a lot of people are saying we can go much higher than this. But the other thing is today and actually in the last few days we saw some of those losses really retracting. We saw bond yields falling earlier in the week. So are we going to see the same speed of increasing bond yields? Are they going to be that scary to markets? That's something we're going to see, and maybe risk assets won't be as reactive as they were in the last few weeks after that big shocking increase in yields.
Alex, the problem with all of this is we're looking at it through the prism of the United States. The US economy clearly is strong right now, certainly if you judge it by the labor market. Over here in Europe, it feels like a very different picture. The UK economy is struggling, the European economy is struggling. Look at what is happening in Germany. We seem to be back to, and you can apply this to the dollar, but I think you can apply this to rates as well, our rate, your problem. Our dollar, your problem. Our currency, your problem. The rest of the world is looking at this with its mouth on the floor, wondering what on earth is coming next.
Yeah, and it's really interesting because I feel like the narrative just a few weeks ago is that the U.S. economy is super strong and that's why yields are higher, and that's okay. Like, then we can all kind of make peace with that. But now that narrative seems to have shifted, and then you get this jobs number. So it does get really confusing on that. Denise, you just moved here. You were residing in the U.K. I mean, are our rates everyone else's problem?
Well, rates is problems for everyone, for sure. And you can see the reaction of every small economic data print trickling down to other rates as well, because everyone is looking at the Fed and what they're doing. Obviously, we're seeing kind of a big disparity of what central banks are doing at the moment, and different paths over there. But the data prints here are very important for everyone. And of course, things are changing a lot in terms of what we're seeing for rate cuts this year. Like last year, we were pricing in nearly 100 basis points, and now that number has fallen so sharply. So that makes a ton of difference for everyone.
Mike, the rate of change is important, and today's number is such a big blowout number. You have to think back to kind of the rate at which we are changing, have changed, maybe are going to change. So far, Mary Daly, talking to Lisa yesterday, talked about the fact that maybe 25 basis points of hikes effectively have been done by the market. But is the Fed comfortable with what we're seeing here? If this continues, at what point do we see more Fed speak coming out and maybe trying to slow things down? Do you think there is going to be an effort maybe to slow things down at the moment? It probably is comfortable now. When does the Fed become uncomfortable?
Well, if you were to see inflation expectations or wages start to rise significantly, then yes, the Fed would become more uncomfortable. I wouldn't even say...
No, but what about the yield story, Mike? With what's happening in the bond market, when would the Fed start to become uncomfortable?
Well, that's a tough question to answer because at this point, the markets are basically catching up to where the Fed is. So if you go beyond that, if we start to get well above 5% in the 10, for example, then the Fed might become uncomfortable with that. But at this point, the Fed is just looking at this and saying, well, they're doing what we wanted them to do 6-8 months ago, and they're finally catching up. And we do see this reluctance in the 10 to breach the 5% level. So given where we are, again, I go back to the CPI report next week. With oil prices going down, with wages growth slowing, there doesn't necessarily have to be a big rise in the markets from here if people think that they are fairly priced.
Disorderly. I think the word we came to yesterday, Guy, was disorderly, and it doesn't feel like then we're still there yet. All right, guys, thanks a lot. Really appreciate it. Bloomberg's Anita Zakova and Michael McKee. Thank you both very much. So coming up, more insight into the question of the day. What landing? Dude, where's my landing? Rebecca Patterson, a former chief investment strategist at Bridgewater, joins us next. This is Bloomberg.
This is very unusual, but there's a reason why this is so unusual, and that's because the characterization of the economy has changed in my mind. What we're seeing here, John, is just a massive reaction to not rates going higher. That was last year. This year is about high rates staying there for longer, and that is a fundamental change of how you think about the yield curve, and that's what we're seeing playing out in the markets.
That was Bloomberg opinion columnist Mohammed Al-Arian earlier today on Bloomberg TV on the reaction to the jobs data. And that brings us to the question of the day, what landing? Joining us now for her take, Rebecca Patterson, a former chief investment strategist at Bridgewater. Rebecca, that's just our starting point, but what landing? Like, is the economy going to land?
I think we're still likely to see a mild recession at some point next year, probably going into mid-year, maybe first half. And I think that because we are going to see the Fed, as it's been trying to get the market to believe for a year, now they finally believe it, they're going to have to hold rates higher for longer. And so this tightening pressure is going to remain and feed through to the economy, consumers and businesses. I also think there's a super important feedback loop that you all touched on in the previous segment. I was very jealous because I wanted to use that line. Our bonds, your problem. Because when our bond yields rise, the bond markets are so interconnected today, it feeds through to other countries that are getting hit a lot harder by those higher interest rates. Their economies slow further. Germany already in a recession, Europe probably going into recession when inflation's still high. Their central bank can't bail them out. So I think that's going to feed back into the U.S. economy, exacerbate our downturn, and likely make us avoid a soft landing next year. I say likely. It's not a super high conviction view, but I think that's my base case.
It's tough to have a high conviction on anything at the moment, isn't it, Rebecca? If you are, though, looking at how much longer the move that we've got currently underway has to go, are we at the point where the markets are kind of in line with the Fed in terms of kind of the 10-year yield? Are we going beyond where the Fed is? How much further do you think yields can rise from here?
Yeah, no, I think that's a great point. At this point, I believe if you look at the Fed funds futures, what the market is discounting for short-term rates going into the next couple of years, we're probably close to what seems right, in my opinion. And that means now we have to focus more on the consumer and the labor market. If we can have better data next week, right? We have inflation coming out. If that's a little bit softer, then people might say, okay, never mind, we're all good, we're still good, take a deep breath. If we get a CPI print that's in line or slightly higher, that's going to keep that nervousness going. And of course, what we've seen with the 10-year, with bonds in general, is that a big part of this recent rise in yields is risk premium. It's the term premium. Mm-hmm. And that is a little bit distressing because that could be a lot of factors. One could be worries about our fiscal situation, worries about our dysfunctional government. I don't know if those go away anytime soon. So I think bond yields can stay up here for a while, maybe not rise a lot more, although, look, a breakthrough 5% at this point for the 10-year, it's not far away. And anyone who says, oh, we're going to see 5, well, big deal. Like, that's not a bold forecast at this point. Right. The problem is if it's disorderly, right? If we get a fast move and it's unsettling for other markets.
I mean, Torsten Slot talked about that, about cost of capital. So that's permanently higher for reasons that don't have to do with the business cycle. Right. It doesn't have to then do with inflation.
And I love Torsten, so anything he says I take seriously. I do think there's a good chance that we settle higher, both on inflation and on interest rates. The question is how much higher, and then how does that feed through not only to our U.S. economy, but also the global economy? I think the degree is going to matter a lot. I can't imagine the Fed's going to let inflation settle much above its target because it's going to worry about credibility. Now, 2025, when it reviews policy, then we're in a whole different conversation.
Okay, so what do you do right now? You're looking at asset classes, you're trying to figure out exactly where you're going to allocate money. The bond market move may have further to go. Am I safe to dip my toe in the water and buy some duration at this point? Has the move fed through sufficiently into equities? Are we starting to see cracks forming in the credit markets? What are you seeing in front of you in terms of what priced correctly and what still isn't?
Yeah, I mean, certainly when you can get 5% on cash effectively, having some dry powder there to me makes a lot of sense just because this coming 6-12 months is going to be pretty uncertain. So I would like to have a little dry powder. I also think in the equity market, you know, we had a nice run for cyclical stocks going through the July through recent period. I prefer having some more defensive sectors in my portfolio, things like healthcare. I also think defense is interesting right now. We're focusing on the budget, on what we can cut. That is one area we have bipartisan agreement. No cuts are coming. The government money, regardless of the cycle, is going to keep going into that space, not only in the U.S. but globally. On the longer term bonds, to answer your question, I would be tiptoeing in. We could break 5. We might get a little above 5. But at this point, your risk of loss, in my mind, is a lot smaller than your risk of gain if we're taking a 6 to 12-month view. If we have a slowdown in the economy, it is very likely, in my mind, that longer-term bonds are going to find a ceiling and the yields are going to start coming down. Even if they don't come down a lot, you're still going to be gaining from that.
So does that mean that the 60-40 portfolio is just toast? Like, does it need to be, how would you be allocating then from that perspective?
Actually, I don't think it's toast. Look, I know there's a lot of very smart investors out there saying you need to rethink it, you need to have a bigger allocation to alternatives,
Private
absolute
credit,
returns.
et cetera.
Right. And I think there's a very good rationale to be considering bigger allocations to that. But having some bonds in your portfolio, I think, still makes sense. The relationships, it's not the correlation, right? Bonds and stocks sold off together last year. It's not the correlation you want to focus on. It's the causation. What caused bond yields to rise last year? Do you think that's going to continue to happen over the coming years? Maybe in the very short term, but over the next 2-3 years, I don't think bond yields are just going to keep going straight up. Again, they might settle at slightly higher levels, but if they can settle in any sense, you're going to be making money off bonds. So I do think you want that allocation strategically.
That's such a good point, and sort of the why and then how that relates to how you view the stock market. Rebecca, such a pleasure. We love seeing you. Thank you for coming in.
Thank you.
Rebecca Patterson, former Chief Investment Strategist at Bridgewater Associates. All right, still ahead, one market mover's Tesla. Guess what? It's cutting prices again. Automaker trying to juice up demand for EVs. We're going to break down all the details next. This is Bloomberg.
That all day yesterday.
It is past 7 on the West Coast. Want to get to the startup. We cover the top tech stories from the Bay Area and beyond. Silicon Valley starts its morning. Joining us now in the studio in New York, Bloomberg Technology co-host Caroline Hyde. Tesla cutting prices again. Seriously, again?
Again, they keep on rinse repeating, and I'm rinse repeating your outfit, so thank you for letting me be color coordinated today. It's interesting, isn't it, that we're seeing in this fight versus inflation, in this fight against the consumer that we're concerned about slowing down purchases, once again, Elon Musk just signals he is not worried about taking profitability down to keep the sales being buoyed. And basically it's because they're able to produce more. There's less of a supply chain angst around the chips. They're able to, having slowed down production in the third quarter that caused everyone by surprise, only pumping out, 435,000 cars. They're now managing to ramp up, manage to dial down the price, and what we're seeing about $1,250 taken off some of the lower range Model 3s and Model Ys.
Yep.
Higher range, you're seeing about $2,250 knocked off.
Caroline, is this a reaction to higher rates? I imagine that a lot of people buy these cars on credit, and the cost of that credit is going up. I'm wondering if the price cut is commensurate with the increase in the cost of financing.
Well, Elon Musk definitely has warned that the macro environment, he's not afraid to go out there and say, look, if you keep on hiking up rates, this is going to be a significant impact on corporate America. So maybe that is him signaling that he has to keep on taking down the price point. This is also, though, a competitive space. We've just seen BYD over in China almost neck and neck in terms of the amount of cars that they're producing now. I think they produced 430,000 in the third quarter, and Elon managed to pump out 435,000. So I think this is also just a competitive landscape for EVs, and he's having to show, look, that I can actually beat you when it comes to the amount that I produce, and therefore the amount of profit that I'm able to just siphon off. It's also interesting, Guy, that of course Elon Musk will come out and say, look, the way that I can prop up my profitability going forward is when you get your software upgrades. I can charge you more for that. But of course that will come down to some autonomous driving as well.
Yeah, you know what's so interesting is that on first blush, you're like, ooh, maybe it's a demand problem. But I think you're totally right. He can do it. Like, he can undercut the competitors, and particularly the ones in the U.S. He can do it. It also shows that he can also change the price on Monday and actually raise prices. But the idea that, like, I can just make these cars cheaper and I can deliver them, therefore, thus, this is the new model.
And in such an incremental manner. I mean, it feels like every week, if not every day. I think it was only a couple of days ago, he stripped down some of the price point on the new extended range Model Y. So we're already seeing that he sort of just does it on a daily whim, as you say. Notably, we'll have to see how it responds to demand.
It's so interesting. So many people are talking to me now about the fact that AI is going to allow dynamic pricing in so many different areas, and you do wonder whether or not this is effectively dynamic pricing. We're not getting demand, we'll drop the price. Demand comes up, we'll raise the price. I wonder how dynamic this pricing model ultimately could become.
And how frustrated it makes people who've just bought the car. I mean, we know how much he antagonized Chinese consumers, because people had just put their money in, got the car, and then suddenly we see big price cuts. So, yeah, you've got to see how it impacts some of those loyal followings that he's already convinced to purchase.
And Guy, also I want to add, what it does to the auto workers. Look at the strike. This is a great example of, like, fighting for pay.
Well, he doesn't have that issue, right?
Exactly. He doesn't have that problem.
Well, he doesn't for now. We'll see, obviously, if they get a good deal, maybe that changes. They're doing dynamic pricing for beer in London as well.
Are they?
If the guy before me gets a cheaper,
a
cheaper beer than me, maybe I'm going to be a little bit annoyed as well.
Berlin's always been
everybody's behind me, maybe pushing the price up. Caroline's going to be,
We're about an hour into U.S. trading session. I gotta be honest, the sell-off in stocks is not as bad as I would have thought after the move we've seen in the bond market. Abigail's tracking the moves. But that said, Abigail, it's been a pretty tough week.
I would agree with you on that. On both points, actually. The sell-off's not as bad as I would have thought. But yes, take a look at this week. And it's a little bit of a roller coaster. The real sell-off was on Tuesday, at one point down about 1.7% that day. Had that happened on the close, it would have been the worst day since March 7th. Here's today's decline on the hot jobs report coming off of the lows. It wouldn't almost be surprising to me if maybe we finish in the green. I know that's probably a little bit out there, but it doesn't feel as though there's a ton of conviction. Maybe the seller's growing a little bit tired, but this is the 5th down week in a row. If the loss holds, it seems like it probably will right now, down 1%, the longest weekly losing streak going back to May of 2022. Why? Well, that hot jobs report, a piece of it, the eco data, yields going higher on the week as investors really contend with the idea that higher for longer. If you take a look at what's happening on the week yield-wise, so the 2-year yield, the front end, not really doing all that much, already above 5%. But take a look at the 10-year and the 30-year. Not so long ago, the 30-year was also back above 5%. So the 2-year, this upside-down world, pulling the rest of the curve higher as the curve re-steepens. Some saying that is a sure sign of a recession ahead. But this move in yields higher, it of course takes liquidity out of the system, makes valuation look less attractive. So net, we do have stocks, again, down for a 5th week in a row. As for one of the worst sectors on the week, funny enough, well, in an inverse way, it's related to yields, but I would argue that New York crude right now down 9.4%. Some people were probably going long crude as a way to go short bonds. Now we have crude coming off of those lows, but nonetheless, a bad week, and you can see the S&P 500 energy index, along with some of the individual movers, down sharply. Well, but most sectors are down this week, including utilities, real estate, and of course, those dividends look less attractive as yields go higher. Let's put it together. I opened this chart for the first time in maybe 3 weeks. We've been looking at it over the last couple of months. I was a little bit surprised because we do have a breakdown on our hands. So the fan lines here, that tells you that there was a reversal of last year's bear market, then this uptrend, but this convergence makes it bearish because the buyers are getting less and less excited. We are now below the bottom of this trend line. The RSI is continuing to go down. This suggests, Alex, that we may see more selling ahead. In fact, I can make the case easily for 4,000, an equal and opposite move of the congestion that we had this summer. So stay tuned. And I think the biggest piece is probably the Fed and now the idea that maybe they are in fact going to have to hike in November.
Yeah, I'm hanging with Bank of America, talking about how you want to be selling the rallies to that level on the high end in particular. Abigail, thanks a lot. Really appreciate it, Abigail Doolittle. All right, let's get a deeper dive into that payrolls blowout number. Julie Su is acting labor secretary. She joined Bloomberg TV last hour, highlighting the strength of the labor market and the shifting balance of power when it comes to labor unions.
We are seeing a resurgence in worker power, in support for unions in the economy, and for working people demanding their fair share, saying, enough of the disparities between what frontline workers make and what CEOs make.
Well, for more insight, we are now joined by Sophia Drosos, Point72 economist and strategist. She just upgraded her 4th quarter growth forecast yesterday to 4%, very prescient when it comes to what we just saw. Sophia, great to see you. Thank you for joining.
Oh, it's great to be here. Good morning.
Good morning. So our question of the day is what landing? And I think it's appropriate, particularly as you upgrade your 4th quarter growth forecast to 4%. 3rd quarter?
It's the 3rd quarter.
3rd quarter, yes. For 4%. What landing?
Well, we haven't seen much of a landing yet. There's been a lot of dynamism in the U.S. economy, spurred on, I think, by the continued reopening effects, which I think we see a little bit of that in the labor market data, in the sense that we're seeing leisure and hospitality continuing to lead the job gains. So there's a lot of dynamism. Real incomes are higher as inflation falls. Consumers have more spending power, so they've been taking advantage of that. And the 3rd quarter in particular saw a lot of one-off effects. So we talk a little bit about the concerts and the movies that help to bolster consumption in the 3rd quarter. And so those are factors that I think have led us to the point we are now.
So what happens next, Sophia? Great to see you, by the way, and thank you for joining us. So what does the 4th quarter look like off that really solid 3rd quarter?
Well, the growth that we've seen in the 3rd quarter is going to be hard to sustain. So we're looking at 4% GDP annualized in the 3rd quarter. A lot of that is because of consumption. Consumption's running at double its trend pace in the 3rd quarter. As you might imagine, it's hard for consumers to keep up that pace. So we look for a bit of a give back in the fourth quarter. The economy is going to hit a little bit of a speed bump, if you will, but we think that there's enough forward momentum that we'll get to the other side without a recession.
So does that mean we're at peak yields for the Fed, or are we at peak yields for the bond market? Like, is that my inference?
So the way we look at it, inflation is starting to make a lot more downward progress. And I think another important aspect from the jobs report today is that we're seeing wages moderate, and we're also seeing supply come back into the labor market. The unemployment rate held at 3.8%. So you're seeing some better balance in some of the wages and price metrics. So our sense is that this will keep the Fed on the sidelines. Policy is quite restrictive already, and the bond market's doing a little bit of the work for the Fed. So it will give the Fed an opportunity maybe to stay on the sidelines and see how things develop. Because once you start getting to 1% growth, which we project in the fourth quarter, you're at stall speed, and any kind of unexpected risk, any unexpected development can push you a bit lower. So there are some heightened risks to slowing growth.
Yep. Sophia, from the Fed's perspective, where is too far for the bond market? Feels like the bond market's caught up to the Fed, and there's a danger now that the bond market goes further than the Fed, and that will worry the Fed, to your point about what is happening in the fourth quarter and the potential for sort of hitting stall speed. When do you think the Fed will be worried that the bond market is doing too much?
Well, I think we're starting to get some sense that for at least some FOMC members that we're at that point already. So the comments yesterday from San Francisco Fed President Mary Daly were quite interesting, talking about how we've seen tighter financial market conditions amplify the Fed's tight monetary policy. And so I look back on it and think that, the Fed raised rates in July, and since then they have not raised short-term rates. But since the end of July, we've seen long-end yields rise 100 basis points. So that's a significant amount of tightening, and the Fed, I think, has the luxury to wait and see how things develop. There's no urgency, I think, for them.
One of the results of today's blowout number, though, is pushing out cuts in 2024. We've already sort of priced out two. That sort of goes with what the dot plot was saying. We'll see 2 cuts next year. What do you think?
So I think that that's fair because we are coming in with a stronger growth momentum than maybe many people anticipated. So if your starting point is stronger, you probably have to reduce the probability of expected rate cuts over the horizon. But we also need to see the trajectory for inflation. And next week is going to be very important as well with the CPI data. And what we've continued to see is downward trend in CPI that is much more in line with the Fed's target of price stability. So a lot depends not just on growth, but also on inflation, and we just have to wait for more pieces of the puzzle to come in.
The degree of uncertainty at the moment, Sophia, must be absolutely enormous if you're an economist. Trying to figure out what is happening here, very difficult. The speed of the move has been very fast. But there's all kinds of other factors we've got to throw in as well. We've got strikes, we've got uncertainty in Washington, D.C. about what's going to be happening with the government. How easy at the moment is it to get a handle on what is happening and to make an accurate call on what that fourth quarter number is going to look like, given all this uncertainty? What's the kind of, if you were to do a fan chart for your calls in the fourth quarter, how wide do you think it would be?
So if that fan chart probably has a little bit more of a downward skew as far as I see it. And I think part of that is the potential for a government shutdown when the current funding runs out on November 17. That's the Friday before Thanksgiving. Congress sometimes has a hard time motivating and doing things around the holidays. And an extended shutdown, I think, could be a downside risk for the economy, not just through activity, but also through sentiment, because it reinforces this concern about dysfunction on Capitol Hill. So there are downside risks, and we need to be very aware of them. As an economist, you kind of keep a scorecard. You watch the data as they come in, and you try to think as best you can about what today's situation means for tomorrow and the next day.
Yeah, and that's what some people are talking about. That you're just going to have a higher for longer level of yields because you have to bake in things like a deficit and term premium and all of that. When you take a look at the market, And when the market moves, right, stronger dollar, dollar yen, you're looking at a mixed equity market now, you're looking at the rise in yields. What makes the least sense to you right now?
Oh, that's a difficult question. What makes the least sense? Look, I think that the markets are contending with this idea that the Fed is going to be higher for longer. And while the Fed told us higher for longer in the past, they were not so specific on what they meant. So in July, higher for longer meant they could still cut interest rates 100 basis points in 2024. And at the September meeting, higher for longer meant higher for longer on a 5% handle. So I think that these are some of the things that are creating bond market volatility and raising some uncertainty about how the pass-through from higher rates will be to the real economy.
In terms of kind of what comes next, do you think the focus should be in the United States or do you think it should be elsewhere? The global economy is interlinked, and what is happening in the US is having a big impact elsewhere. Over here in Europe, the economic outlook doesn't look as rosy as it does in the United States. The labor market certainly doesn't look as strong, yet Europe is being impacted by the higher rates that we're seeing in the United States. How are you thinking about the global feedback loop? If Europe has these higher rates and slows down dramatically, how does that work back into the US economy?
So there are feedback loops through our financial markets. And what's been interesting to me is that the backup in yields in the United States has been mirrored in global economies. And as you say, perhaps the outlook in Europe doesn't justify the rise in interest rates that we're seeing, but they're getting dragged along by the U.S. Same thing for emerging markets. Many of these central banks are already on interest rate cutting cycles, and the move we've seen in U.S. rates has been spilling over there and pushing up expectations for higher rates. So what we're seeing really is that the financial conditions in the U.S., be it through higher interest rates or a stronger dollar, are starting to impact other economies. And if it's persistent, it could be a factor that slows global growth.
Yeah, this is all for Guy to say that he was right. It's our yields, his problem. I get it, Guy, I get it. All right, Sophia, thanks a lot. We really appreciate it. Sophia Drossos of Point 72. Thank you so much. We appreciate it. Definitely come back. Coming up, all right, let's get excited. It is a huge, huge deal in big oil. Exxon is in talks to buy Pioneer Natural Resources. This will be the oil giant's biggest takeover in 20 years. We're going to get the details with Paul Sankey, lead analyst at Sankey Research. He's always got opinions. This is Bloomberg. All right, time now for ETF Friday. We've been focused on the extreme pressure facing bond markets, right? You get the 30-year yield surging nearly 70 basis points since the end of August, and that sends ETF investors into a frenzy trying to trade this new rate environment. Guy, check this out. As a result, the TLT, that's a fund that tracks bonds on the long end of the curve, has seen volume surge. Yep. Trading activity apparently hit a record last week and is on pace to top that level again this week. I don't know. No surprise on my end.
The TLT's been boring for years. This has been the most boring product out there for very good reason. Basically, since the GFC, nothing has happened. Now everything has happened. This is like the epicenter of the action.
Yeah.
And it's amazing. The amount of money that's been pulled out of this thing is eye-watering.
Yeah, no, exactly. And you have to wonder, too, if this helps pick up volatility as well, and if that volatility kind of moves to other areas of the market. Here's one area I'm looking at when it comes to volatility: oil. Energy space. But that's not, they had a huge drop for like barely a lot of reason on a headline level for oil over the last couple days. And then we get possible news today that Exxon could be buying Pioneer Natural Resources, the largest takeover for Exxon in over 2 decades. It would be something along the lines of about $60 billion. Joining us now with some insight is Paul Sankey, Sankey Research lead analyst. Hey, Paul, always good to see you. So this is what I think the first time I see this headline. Back in 2010, Exxon buys XTO Energy. That was basically the top in natural gas. Gas prices sank after that, and it has literally been labeled, this is how you don't do M&A. Then you get 13 years later, you get this deal. That tells me, are we at peak Permian? What do you think?
Well, there's definitely a risk. I mean, I thought, the old question, which it was, when ConocoPhillips bought Burlington the day before the all-time high in U.S. natural gas prices, the question was, why didn't you wait until March, wait until after winter? Because obviously if winter comes in warm, we could be looking at a lot lower oil prices by March. And yeah, I think that the driver of the deal is clearly that Scott Sheffield, CEO of Pioneer, is retiring, and therefore they put the hurry-up offense on. As you mentioned, with volatility, I would think they were negotiating this deal when oil was 75. It went to 95, and now it's at 85. I mean, that's the problem. We assume for that reason it's an all-stock deal for Exxon.
So this is just an exit strategy. Is that the right way of thinking about it?
Yep.
Yep, no, okay. Good answer.
If that's the case, no, fairly straightforward. If that's the case, what is the danger that Exxon is going to overpay? And what would overpaying look like, do you think, in this kind of market?
Yeah, well, it's, normally we take Wall Street Journal stories to the bank. We assume that due diligence means that the deal will happen, but we don't have any details. I mean, we know it's a $60 billion, we assume, EV deal, but we don't know where the debt lies. I said it's for sure a stock deal. We actually don't know that for sure. So there's a number of major uncertainties here. And as I said, the story actually hedges itself by saying this might not happen.
Of course,
but it's been widely anticipated, and we know that with Scott Sheffield retiring, there's a good chance it will. What does it mean for the sector? It might be negative for a couple of stocks like Oxy, where there was a hope they would be taken out perhaps by Exxon. But broadly speaking, we're not seeing deals here at huge premiums, and if it's an EV deal, this is only a 7% or so premium to a stock price that's been under a lot of pressure. It's been part of a pattern here, which is sort of depressing for oil investors, because you're not getting the blowout. Exxon's lost its mind, it's paying a 25% premium. It doesn't look like it'll be that deal.
Well, that's such a good point, Paul, because if you look at, say, the XOP versus Pioneer's underperformed, and part of what's really worried analysts was lack of productivity. So basically, the super cool, awesome stuff in the Permian's been drilled, and so productivity goes down. Then you have to drill longer laterals, so we're now at like 3 miles in order to get more oil out. That comes with risk. Is this a sign that like Permian has peaked and now it's going to be that much harder and more expensive to get the other stuff out?
That's debatable. It depends on your oil price assumption.
Fair enough.
The Permian's a zero if oil's 20. But, the potential for us to have sustained higher oil prices because the Permian is peaking is very real, because as you know, this has been the marginal growth driver of global oil supply for the past decade. So it's hugely important when it rolls. And the oil rig count suggests that it will. The other thing that obviously is hugely important is you're consolidating the sector. Look at the refining sector. You consolidated it, and you ended up short U.S. refining capacity. You consolidate U.S. E&P, eventually you're going to stop all the model, which is you grow, and then you sell it to Exxon. As that plays out, you have a highly consolidated sector, and you have much higher returns. That's what happened with refining over the past decade. I think it's what will happen with big E&P in the U.S. over the next 10 years too, is that now that you're consolidated, they'll drive very high returns.
Paul, why is oil down so much over the last week, and will it continue to fall?
Well, we always think of Saudi cuts as bearish. It's a bad sign if Saudi's cutting, so they can crank the oil price up. But why are they cutting? We want Saudi at max with strong demand. For Saudi to be cutting into weak demand is fundamentally bearish. So they took a market where speculative interest was low. They drove it to 95. You saw a pretty direct response in U.S. gasoline consumption, which also fell seasonally. And the gasoline crack just collapsed because you pushed up the crude price and you're seeing weak gasoline markets. And as a result, essentially, you're going to shut down refining, which is going to be bad news for the Saudis. So my view on the cut was that it might work for 6 months, but it might cause you a major problem in mid-2024 when the market's very weak and you have to decide whether you're going to really seriously cut more or you're going to crank up and go for oil market share.
Hey, Paul, can you make money right now investing in oil stocks? How hard is it?
Well, you can on the short side.
Okay, fair enough.
You've had some stocks hitting 52-week lows, which is normally a very bad sign. I think that the market will stay fairly lively just because of distillate tightness globally into winter. You're seeing natural gas acting well, so we like U.S. natural gas plays. We think that's a long term. There's things that we love secularly long term. One actually, funnily enough, is U.S. refining, but another is obviously these Marcellus plays, our EQT, our range, are great long-term stories. And the consolidated remnant, that is the Exxons and the Chevrons, I think will do very, very well over the next decade. So it depends on your timing. If you want to make money now, I'd basically be on the short side. But, we're always looking over time to actually view this sector as fundamentally undervalued by the market because of the importance of oil to the global economy. And I think that'll remain the case for the next 10 years.
If you were thinking about... That was quite the answer. No, I will go away and watch that back and figure out all the little bits and pieces that I need to take away from that. There is definitely some positives in there. Paul, but if you think more broadly about what is happening here, are we setting ourselves up for a fight between the market and the Saudis? How low do we go before the Saudis react again? Is the market prepared to go toe-to-toe with the Saudis here? And if they do, if the traders do, what does that look like?
Well, I think the first thing is the administration, despite their rhetoric about the green agenda, clearly want lower oil prices. Particularly, it becomes a bigger and bigger issue as we hit election year next year. So they're fighting for lower oil prices. What did they do last year? They downloaded 1 million barrels a day of the SPR. They basically sold it direct to China, which built inventory, by the way, but whatever. This year, they can't really redo the SPR. It would be, I think, a little bit dangerous at this point. But what they are doing is they're turning a blind eye to Venezuela or actively encouraging a democratic process in Venezuela to be positive. You've got them selling turning a blind eye to Iranian oil coming out, which is really upsetting to the Saudis in terms of market share, obviously. And then, of course, you're turning a blind eye to Russia. So the administration has basically looked away at all the additional incremental supply, and all of that is taking Saudi market share. So I think that Saudi's between a rock and a hard place here, and I think they might end up having to go for market share and crash the market. I really do.
Yeesh.
Wow, okay. That will be something to watch. That will certainly have an impact on all the other data in a fairly big way as well. Paul, great to see you, great to catch up. Thanks for the insight as ever. Paul Sankey of Sankey Research. This is Bloomberg. Quick look at the price action. European stocks bouncing around all over the place since the close, into the close, out of the payrolls. Up, down, up, down. On the week, we are lower in terms of today's price action, actually reasonably resilient, you could argue. Euro dollar is down, but it's been down more this week. I think that's a really interesting point. Similar story with what's been happening with gilts as well. Yeah, we're seeing yields higher, but again, in some ways, a much more muted reaction than you would have anticipated to the payroll number. Jerry Fowler's going to join us from UBS. He's going to try and answer all these questions. This is Bloomberg. Friday the 6th of October, stocks are higher, and they're not convincingly higher, but they are higher. And given the blowout payroll number, I find that in some ways a little bit surprising. This is a very strong economy in the United States, which in theory should move to higher yield, which should in theory be bad for stocks. Doesn't feel like it's working out that way. Yes, we're down on the week. Maybe that's what we should be talking about. Anyway, that's the picture. Countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Okay, look at this board and tell me if we just got a massive, almighty blowout payroll number. Because you look at these numbers and you're thinking, nah, end of the week, nothing really to see here. We can move along until next week. We just got a huge, huge print out of the United States. This is a big piece of data, and it was massive. And the market in so many ways has shrugged its shoulders. Maybe we've already had the move. That's what we're seeing here. Maybe we're going into the weekend. Maybe we're thinking about the CPI data next week. But the stock 600 is up by 0.5%. We're trading 443. The pound is barely budging, 121.89 against the dollar. German yields are a little higher, but we've been north of 3 this week. We're not there yet. We're at 2.909. So you look at this board, and I don't see, Alex, a big blowout payroll number. But that's what we got.
I mean, same deal here in the U.S. with the exception of the bond market. So just look at this one. 10-year yield up 9 basis points. The 30-year made a run for 5%. All of that feels very dramatic. But then nothing else at the same time. Like in the middle of the week, the S&P, we were talking about the 200-day moving average. I mean, like 26 points away from that. We are well off that level now. We're just down by 0.1%. Now, part of the reason why that index is actually doing well is Pioneer Natural Resources. The stock is up 10%. The best performing stock within the S&P. That's on takeover rumors between Exxon and Pioneer. Now, even the Bloomberg Dollar Index, we got an initial pop higher for the Bloomberg Dollar Index, dollar yen again making a run for 150, and then we kind of paired some of that. Now the currency is a little bit mixed, just up 0.2%, Guy.
Yeah, but it's not. This was the number we've been waiting for a week. This was going to be the huge moments. And I'm not entirely convinced that the market is taking it that way, which is a little disappointing on a Friday. We were expecting kind of fireworks this afternoon. We're not in some ways getting them. We are, after all, in the volatility business. German 10-year, here you go. Here's the 5-day. Wednesday, we get 3%. We go through 3%. We fade that pretty quickly. And as you can see, we have seen that's the pickup there on the payroll number. That's Wednesday. Now, there's all kinds of other things going on earlier in the week, but that's the pickup off what I can only say was a massive move on the data that we've seen, Alex. But maybe the market's already kind of through that and is already thinking that it's priced this. I don't know. I'm a little confused.
Yep. I don't know either, and that's why we're not the experts. Good sign. Sophia Drosos is .72 economist and strategist. We talked to her earlier about the hot payrolls number and what it means for the Fed and what it means for growth.
Inflation is starting to make a lot more downward progress. And I think another important aspect from the jobs report today is that we're seeing wages moderate, and we're also seeing supply come back into the labor market. So it will give the Fed an opportunity maybe to stay on the sidelines and see how things develop.
Yeah. Wait, watch, see what happens. But at the moment, this is an economy that feels like it's riding pretty high. She's just upgraded her third quarter GDP forecast really quite significantly, Sophia. Fourth quarter, yeah, we're going to hit a bit of a speed bump, but maybe we get through that, maybe we don't get a significant recession. And that takes us to our question of the day. What landing? Joining us now to discuss, Eddie van der Volt from our MLive team, Ira Jersey of Bloomberg Intelligence. Eddie, you're standing next to me. What landing?
Well, I have to say, to me, this is what a soft landing looks like, right? Okay. This is what we're seeing here, what we got from the jobs number, first of all. We got a hot reading saying, you know, the economy is growing strong. At the same time, you've got inflation coming up, wage inflation coming off a little bit, and you've still got some room in the participation rate for more workers coming back. Therefore, what do you see? You see yields having to build in a steeper yield curve via the back end. You see bears steepening, and you see the stock market saying, well, we can cope with that because the economy is strong, people are going to keep buying, people are in jobs. To me, this is the perfect reaction. I think the initial reaction was what you would expect, hot reading, you know, high inflation maybe, or you know, Fed that's going to hike, and therefore you see the equity market pull back. But I think people are looking at it now and saying, no, this is actually really exactly what the Fed is aiming for.
Hey, Ira, I mean, the bond market's still selling off. Do you agree with what Eddie was just saying?
Yeah, Alex, we've talked about this. You know, if the Federal Reserve doesn't cut interest rates in 2024, which is actually our base case scenario here at the Bloomberg Intelligence Rates team, then you know the bond market needs to be much flatter. And in particular, what is the interesting trade to me that's not happening is that you don't really see the 5-year sector selling off more than the rest of the curve, because that's really the adjustment that has to take place if the Fed's on hold for even longer than we think, which, you know, you keep on getting data like this, and you have to keep on pushing out when you think the Fed might actually have to cut rates, and that's no time soon, at least based on this data.
It was interesting, actually. I think the kind of the biggest moves initially did come in the 5-year, but as you say, that has since subsequently, that move has retreated. Are we at the point where the Fed and the market are now aligned? Have rates come up far enough to kind of align themselves with what the Fed is thinking? And if rates go further from here, do you think the Fed will be worried?
Well, I think we were at what the Fed was thinking if you just take the dot plot as gospel, which of course you can't, but if it were, then 10-year yields should be probably about 40 basis points lower. So basically where we were 2 weeks ago is about fair value based on what the Fed thought. So the market's basically saying that, hey, the Fed's going to have to shift their opinion, in particular because the data has been much stronger than just about everyone has suspected. I mean, you look at, the jobs numbers today. You guys have pointed this out on Bloomberg TV all morning, that it's almost 100,000 above even the most optimistic estimate, right? So I think as the economy changes, the market is going to instantaneously shift what it thinks the Fed's ultimately going to do.
Any Citi overnight, before the number, upgraded their call on global stocks to a buy, saying like, look, we have balanced macroeconomic risks, like buying dips, like cyclicals. Does this data make sense to you with that call?
Look, I think so. I think unless you are seeing some sort of major correction brought on by a higher yields, which triggers then, which triggers an event in which the Fed has to cut, which is then a bull steepening and a very different scenario. And that's the sort of steepening that markets are used to trading. So it's not a surprise that people are pivoting that way. But, in this environment, as long as the economy remains strong, then, it makes sense. Why not go for the NASDAQ? Why not go for the speculative stocks? I will say, though, that we're inverted on the 2s, 10s by about 27 basis points at the moment, right? The next 27 seems easy. It's what comes after that. Yeah. How much of curve uninversion do we get beyond that? Because it could be significant. And if that goes much, much further, that could start to, I think not a lot of people know just how much higher 10-year yields have to go.
And over here in Europe, we're looking at this, scratching our heads, wondering what's going to happen next. The Fed in the past has had to react to global events. It is theoretically the central bank of the United States, but in the past, events have come in and force the Fed to react from outside of the United States. Are we setting ourselves up for that scenario again? We're sitting here in Europe. The economic data is not very good. Many parts of the emerging markets are already seeing cuts coming through, yet yields are going higher. We talked about this earlier. They are their yields over there in the United States, but is it our problem? And is that where the problem is going to start?
And then exported back to the US and, the circular. It's possible, right? The PMIs in Europe still look like a stagflationary economy, right? It looks like the PMI numbers are still very, very weak. It shows that there isn't growth, but they do appear to be bottoming out.
But that was before this kind of, that's before this kind of big rise in the cost of capital came through once again, exported by the United States.
Yeah, and it is a problem for Europe, and I think that will remain a problem for Europe. I think the US is fairly immune to contagion risk unless there's some sort of banking crisis again, right? And we had that earlier in the year, but I don't see that with higher, steeper yield curves. I just don't think that's a problem for the banks.
Hey, Ira, game this out for me on the short term. What if we get a hot CPI on Friday? What happens?
Yeah, then I do think that we could have even more of a flat yield curve. So I do think that there's a limit, just talking about the curve discussion a little bit, I think there's a limit to how steep the curve can get in a bear market. So with 5.1% is more or less the yield on the 2-year note, if the Fed is on hold for the next 18 months, then it's going to be difficult for 10-year yields probably to get above that level. So you could have a pancaked yield curve, but eventually the next big steepening of the curve probably has to come more from a significant bull steepening, so 2-year yields being much lower in anticipation that the Fed's going to cut. But a hot CPI number, we can get to a pancaked yield curve in a hurry. That could be one trade right after we get a pretty hot, like a 0.4, 0.5 on CPI next week.
Yeah. Very gappy markets, as you say, you could move very quickly to that, and as you've said to me already this week, then you maybe stabilize. Ira, what's the relationship with oil going to look like over the next few weeks? Oil has come down really sharply this week. And I'm wondering if that sticks and persists, what impact that's going to have back into bonds.
Well, it has some effect because of the expectation, again, of inflation and how it affects inflation expectations. But keep in mind, most of this move, in fact, all of this move, has not come from the inflation expectation side of the rates markets. Yep. It's really come from real yields going up, people thinking the economy is going to be a little bit hotter. That means that things like R-star that we always talk about is probably even a little bit higher than we had suspected it was just a few weeks ago. So it's really the real yield move here that is quite dramatic. And, you know, we're talking about 5-year real yields potentially hitting 3%, which we have not seen since, it's been almost 20 years since we've seen that type of level on short-term real yields.
Yeah, it's such a good point. We keep forgetting that it's not inflation break-evens that are moving it higher. Hey, Ira, thank you so much. Ira Jersey of Bloomberg Intelligence, and Eddie Vandervalt, always a pleasure to see you as well from our MLive team. Coming up, we're going to get more insight into the question of the day, what landing? Jerry Fowler, UBS head of European Equity Strategy, joins us next. This is Bloomberg.